Welcome back, guys. Today we have Omar. He is actually a day trader, so he actually wants to learn to invest with his day trading. So, Omar, tell us a little bit about your day trading.
So I actually started prop firm trading pretty recently. Before this, I wanted to learn. I wanted to get into something with stocks, and I honestly thought intraday trading would be a really good way to make a good amount of money. At first, I thought it was a obviously get rich quick scheme. It's usually what everybody believes is the case. And, I saw a lot of like TikTok gurus and all these people that were trying to sell me courses. And I started learning through like TJR. He's like one of those people that you could say is a more trusted guru.
The community, yeah.
And I started learning from him, and I was learning for about a month. So I've only been doing this for actually only like 2 months now. I did prop firm trading, blew one funded account, blew like 5 evals. So I lost about like $500. I'm $500 down.
Yeah, that's like expected when you start. So if you didn't know, guys, like 99.6% of like day traders, they don't fail. I mean, they fail, but like Omar here is actually just beginning to get profitable. Can you tell us about that?
Yes, actually. So recently, last 2 weeks, so I'm a futures trader. I've finally, after countless losses, I finally just started to get my mental together, and my trades have been much better. And for the last 3 weeks recently, I've passed an eval, and this time, instead of blowing my funded in one day, I actually have kept it now consistently, and I'm currently about 1,600 up on the funded. I'm trading with Top Step right now. So once I get to about like 3K, I'll be requesting 3K, 3.5K, requesting around my first payout, hopefully in about like a week or two. And that first payout's going to be around like 1,500.
1,500. Dang, bro, that's really impressive. That's really impressive, especially since you do see like propaganda about day trading like being a scam. But obviously, it's not a scam. He's doing it right here, and his father. You said your father does long-term investing, right?
Yeah.
And then he said you wanted to start integrating long-term trading, long-term investing into your day trading to become like save up. So what are your plans for that?
So recently with trading in itself, I've been trying to, reinvest my payouts into something long term. So obviously this first payout is going to cover the 500 that I've already lost. So I have 1,000 left to go. And I was just thinking, with every payout, if I can allot like a percentage of it into long-term investing, along with like money from work, from my job, I can consistently put in a small amount of money so far every month, and then scale it up as we go into long-term investing. But that's why I just wanted to learn a couple things about it, because, based on from what I've been talking to you, and obviously from my dad, he doesn't know anything about day trading, but he knows a lot about long-term investing. And it's hard to actually have the same conversations with him about like day trading and long-term, because they have so many differences. And I generally feel like the long-term investors are the ones that have the true knowledge of the stock market. Whereas the day traders, we're using little strategies on certain like futures or foreign exchange. And it's mostly like these 10, 20, 30 minute, even maybe 1 hour moves. But the long term and what actually is going on, I feel like it lies in long term investing.
Yeah, that's actually perfect. Like, so many day traders probably don't even do this. So if you really are a day trader, like Omar, like what I was saying is like it's really optimal for him to be taking out profits. And first of all, like building his account, but you can also take out profits because you want to start long-term investing. That's one of the true ways to build it up over time to eventually expand and become a millionaire. Even though he's very profitable as a trader, something could happen. You could eventually lose it all. So he wants to tuck it away in an optimal way. He doesn't want to put it in the savings account or like spend all of it. He wants to buy some of the things he wants, keep going trading, and invest for the long term. So, you did come up with a couple of different questions because you don't have enough knowledge over the long term space. It's kind of actually I didn't realize how different trading was in long term investing, but so go ahead and fire away some of your questions you have for us.
So, the first things first, one thing I've actually been really interested in recently is like the Nasdaq, since I do trade the Nasdaq E-mini futures. But I realize I don't even really know what these futures are. And I just wanted to know like why, like what's the difference between the Nasdaq, the S&P 500 and the Dow Jones? Because I realize the Dow Jones has very minimal volatility. Even though most of these charts are moving in congruence on the futures, I noticed that the Dow Jones and the S&P 500 have less volatility than the Nasdaq. But I'm hearing from, I see other investors talking about how the Nasdaq is not the best for long term. The S&P would probably be better for long term. But the Nasdaq is really good for the intraday trading because of that volatility, for me at least. So I want to know, like, what is the difference between all three of these indexes, since they are the biggest in the United States, I believe?
Yeah, of course. That's actually a really good question. These are the indexes you have off. You said Dow Jones, S&P 500, Nasdaq, and there's one more, the Russell 2000. So I'll just explain the difference between all four of them. First of all, whoever said that the Nasdaq is not as good for long-term investing as S&P 500 is completely wrong. Because basically, in my experience, they're basically, I would say, equal. They have both of their high points. The one that wouldn't be as good at all would be the Dow Jones and the Russell 2000. So main differences. So you said, the Dow Jones wasn't as volatile, right? Correct? Yeah. Well, the Dow Jones is more of like the blue chip companies that have already grown are gonna stay there and like aren't focused on technology, like Home Depot, Visa, like a bunch of those stable companies. So they're not going to grow as much, but some people like to put their money in there technically if they want something more stable when they get older. But even if that isn't like the best option. That's why a lot of long-term investors, they don't really do the Dow Jones. And then the Russell 2000 is the 2000 smallest companies. So like super small companies are just getting up in the United States. Those are what they deal with, and people usually invest in there when there's like different like interest rates with Jerome Powell, because when you're able to borrow more cash for less interest, then smaller companies benefit because they don't have much cash as something like Google does, right? Google, Amazon, they have like billions of dollars in cash, but small companies don't. So that's where they can borrow against it, and that's why those two aren't as popular, because they don't move as much and they're a little bit more risky, of course. And it's a difference between the Nasdaq and the S&P 500. The Nasdaq, I'll mean specifically the Nasdaq 100, or ticker symbol QQQQQM. He doesn't really use ticker symbols with what he does, but basically it's top 100 non-financial companies in the Nasdaq, or the top 500, 100 technology stocks, which is what you would be investing in if you weren't doing, if you're investing and you wanted to do Nasdaq. This is what you would do. It's kind of different than the regular Nasdaq. But the reason why it's more volatile when you're trading is because it's filled with almost all the technology stocks and non-financial stocks. So you're getting like Amazon's, Tesla's, Google's, Nvidia's, AMD's. All of them are all like people who create chips for the computers, people who create these energy sources. They're going to be more inherently volatile because there's so much growth behind it. They're not like stable companies compared to the Dow Jones. And the S&P 500 is one of the best because it's a mix of the Dow Jones. It's a mix of the Nasdaq because you have these high growth stocks and you have the stable companies. And at the top, since these high growth companies from the Nasdaq are going to be near the top, while stable companies are going to be lingering near the middle in the end, basically what's going to happen. And you have smaller companies, but it's not one of the reasons why it's the better thing, because it's not a mix of the Russell 2000, because you don't have any small caps. So I want you to get it all the way really quickly. You want to be investing, S&P 500 is the best because it's the largest. Because like I said, I explained to you, right, with the MasterCard, I told him a little trick to take out his wallet, and I could guess what type of cards he has in there. You know which two cards it was in there again? Yeah,
so I was using a Visa, and I noticed most of them, like my family mostly uses Visa and MasterCard pretty much. Maybe sometimes American Express.
Yeah. They're such large companies that basically they can charge a little fee because they have billions and billions of transactions per day, where a small company couldn't really get into the space because they would have to pay a larger fee. And if they tried, Visa and MasterCard would just lower the fees to the point where this knocks them out of the competition. So that's, like I said, I mentioned Amazon, mentioned Google. They really have no competition. Like in phones, your phones automatically go straight to Google when it searches something up. And if you want to get a high quality product inside of the US fast, then you go to Amazon usually. So what's your next, did that explain your question, or do you have any like other questions around there?
Honestly, that was actually something new. I did not know that I thought the Nasdaq was mostly just financial stocks. I didn't know it actually had the technology.
Yeah, but I'm not sure.
It's a good mix.
Yeah, the actual Nasdaq, but the Nasdaq 100 is like what you if you're like doing a long-term trading, you'd go on the Nasdaq 100 specifically. So it's the 100 technology. Not sure which one you're trading, but it's going to be inherently more volatile because it does have larger concentration in technology stocks.
Gotcha. Yeah. So actually, my next question, still based off of that, is what exactly are the futures that like that are coming from these
trading?
indexes. Yeah.
Oh, the futures that you're trading. So like you're a future trader, but you don't really understand
what the futures actually. Yeah.
Yeah, it's kind of like I'm not a futures expert, but from my knowledge, it's basically like they don't like, for example, like the stock market can move up on one day, but then the futures could go down, like totally different, because it's based on like kind of like predicting like all these different type of tradings. All these trading names, their name really tells you exactly what you're going to get into. So options trading, it gives you the option to buy or sell at a specific price, and you're selling contracts. So you can have the option for it to go up or down and sell whenever you want. That's why it's an option. In futures, it's trying to predict the future price in a move beforehand in the product, which is basically when you're trading futures, you are trying to basically it's trying to predict the future of what the price point is going to be based on different market conditions or economic conditions, tariffs, stuff like that. It's going to affect them as a whole because you're using these large indexes. It's not just one company. You don't focus on a company. You focus as a whole overall economy in your Nasdaq, which is why it's basically affected by the overall economy. Very different if you do futures on like corn or peas. Now that's very professional stuff right there and a little more risky. And there's also Forex, which is basically like Forex stands for like foreign exchange, which you just trade currencies for one another. So like the names are like the name basically states it. You just have to go a little deeper. I hope that's understanding what futures.
Yeah. Awesome. Yeah. So I was thinking, why do you believe? So based on what you've been telling me and what I've been hearing, I do get mixed opinions actually, but I do understand why do you think indexes will be better most of the time than just buying or selling like indivital stocks?
Yeah, that's a great question. I actually made a video. I'm not sure if I'm releasing it before or after this, exactly about it's titled "The Best Investment of All Time," which is the S&P 100. So I'll break it down for you. Oh, I literally have this jar of rocks. Okay, I just literally randomly. This is not scripted. I saw this, and I'm just gonna use this. So this jar of rocks. So basically, this is your S&P 100. It has different types of rocks in here. There's small rocks, there's different shaped rocks, there's different types of colors and different. So basically, and the rocks are shaped by market cap, and the smaller rocks are on the bottom because they contain more of the smaller companies and they all congest, while the larger companies stay on the top, and they're obviously bigger, or maybe sometimes they're like 10 to 20% bigger than the other companies in there. So basically, what's going to happen is in a S&P index. Basically, so overall, the idea is the market always goes up over time. So if you look up the historical average, S&P 500, it's going to be 8 to 10% before inflation. So that means if it's positive, that means overall we expect the stock market to go up. So that's where we get the idea of when you invest in individual stocks, you don't know if the stock's potentially going to go up or down. Let's use Google. It goes down to 50%. Well, you just lost 50% of your value in here. But if Google goes down 50% in this jar of rocks, and maybe it goes to zero, and you take it out completely, this jar of rocks looks almost exactly the same if you put this in there, just with a small difference. And let's say a smaller company goes out, you can't even really tell that this jar of rocks is different. That's because you're basically taking away less volatility because there's so much in here. And since the idea is it goes up over time, is that it's going to be better long term. But for that example, you might think this ETF or S&P is better. But let's say Google goes up 50%. Well, then you get 50% in this huge rock, and this rock is humongous, right? But if this rock doubles in size and it's still, again, you can't really tell the difference. So with that, you may think single stocks is better because you're getting more of the return from the company. But more risk downside, more risk upside. Here's the kicker, though. And it's kind of really hard for people to actually pick out stocks. The idea of having all of these stocks in here is the greatest thing. So why is this? Because it's the largest, 500 largest. Like I said, the largest companies, they control, like United States. Whole entire market cap, every single purchase, 80% of the market cap. That means every $100 you're spending, 80% of it goes directly, most likely, to the top 500 companies in the United States. And the smaller companies, they don't get their money from anywhere, right? So the larger companies, they reinvest money into small companies that they have faith in. So realistically, since they own so much share of the smaller companies that are on top 500, realistically 95% of the United States market and going in and out is controlled by these top 500 companies. So if you spend $100 on something, 90% of that, like over the long term, like let's say you spend like $50,000 something, a lot of that is basically 90% of that is going straight to these large cap companies. They control everything. And since they're the largest, they have a competitive edge. People like to look at undervalued companies that could potentially be smaller than the company. And they're trying to get from this to here. But these smaller cap companies that just started, they only have a 90% chance to reach here. Well, these large cap companies, they already got to here. We didn't have to take a risk of betting on something to go up or down. It's already the largest and they're dominant. Like I said, Amazon has really no competitors. Google doesn't have any competitors because it's like that. MasterCard, Visa, those companies like that. Did I answer your whole question? Or?
Yeah. So if that's the case, with a lot of stocks, people say, high risk, high reward.
Mm-hmm.
Would you say that's good for a beginner investor?
Like individual stocks?
Yeah. For example, like, individual stocks, like you said, putting in a 50% decrease in Google would be much worse for you than it would be if you just had invested in the S&P 500.
Well, here's I probably explained this part actually.
But the 50% increase,
And the thing is, holding stocks isn't bad. I'm like kind of weird with this because I would encourage new investors to actually take like 10% of their portfolio and do it in single stocks, because if they really want to like do investing in single stocks, start small, 10%, and as your portfolio gets larger and you have like go from $1,000 and you're 10%, we have $100 to play with. Well, if your portfolio gets to 100K, that's $10,000 to get to play with single stocks and try to beat the market, because since it's like technically you don't know, you have equal chance of trying to pick a good company. Technically, you do it right, which I'll give you that. So basically, you're risking the same percent if you're playing with $100 with $1,000 portfolio as you are with a $100,000 portfolio playing with $10,000.
Yeah.
So, but the thing is why it's bad is because people, to get this diversification, is 500 companies. You have to try to go in here and pick and choose more than 10 companies in your portfolio. You have to pick and choose which ones you want. And a regular person, a newbie, can't do all this analysis on all these companies. And with S&P, you don't have to do any analysis. When the stock drops, which it will eventually, they don't go up forever. When it drops, you have to figure out, is this company going to survive the recession? Is it going to get replaced by something? Is this a good undervalued company, or is it just going to keep going down? Like catching a falling knife is the idea. Versus this, it goes down. Well, we know overall the economy goes up in the long run. These are a ton of companies. We don't have to pick which one. So we just buy a dip with literally you don't have to know anything about it. You just buy it because it's so many in here. You don't have to do technical analysis. You don't have to do quantitative analysis. This is proven, and it's proven through statistics and historical averages, which is why you do this. But yet again, there is a potential to outperform single stocks, which is why you can start off with this like 90% ETFs, S&P 500. Also recommend a growth one. Not financial advice. This is my opinion. This is what I hold. I hold a growth ETF too, because it's more like the technology stocks that grows over time, because these also have financial stocks and like blue chip companies. But 10% play around with it, have fun. If you really want to have the most fun, pick a bunch of different companies and have a lot of them in there. So your 10% has the best chance to succeed. But people do like tend to over concentrate. If you have hundreds of companies, you can like a little, if you're investing in individual companies, here's a little trick I want you to do. I want you to go and remember each company you have in your portfolio, like say it off. Don't read it off, and say exactly why you hold that. And if you can't do that for every single company in your portfolio, then you shouldn't be holding it. So basically, I can go exactly. Yeah. So let me do it for you. So 17.5% of my portfolio, Amazon. Basically overview I'm holding. Strong e-commerce, just dropshipping based business, robotics. Next, second largest, I have ASML, which is basically NVIDIA. It creates the chip makers. I showed you the video. It's like, it has 90% monopoly over like the machine, the one in the entire world that makes the machine. So nobody else can get the market share. And the next, around the same areas, I have Uber, Meta, and I have Brookfield. Brookfield, private equity corp, kind of like Warren Buffett's company. Uber, only website / app that's doing rideshare services like taxis, and they're partnered with Lucid, which is the electric car company, and Waymo, which is Google's.
How about Lyft?
Lyft
does it compete with Uber?
Yeah, sorry, I probably forgot. Yeah. It does compete, but Uber is basically the main dominant, and they're getting partnerships left and right, which is why. And one of the reasons I took notice of this, because one of my favorite super investors, Bill Ackman, who was like billions of dollars, he bought into it, and so like, oh, I'm gonna follow you in here. And then Meta, subscription-based sorry, not subscription-based. It has subscriptions, but ad revenue-based company. Ad revenue. They have Instagram, 2 billion Instagram, 3 billion on Facebook, monthly active, and 3 billion on WhatsApp. The reason I bought more is because they just added their WhatsApp ad plan. There wasn't any ad plan on WhatsApp, which is adding 3 billion users to ad, which is obviously good. And I can go down the list. I have 36 active holdings right now, all the way down to like Lunar, some of the smaller caps, SoFi that I have on, but near the, I also have MasterCard, Visa, S&P Global, Moody's. I won't go down on the list. If you're interested, the only crypto I endorse personally to hold is Bitcoin and maybe a tiny bit of XRP. But all right, sorry, I was rambling on.
No, awesome stuff, dude. Seriously.
That's a little task you should do just to see. And if honestly, it's kind of hard. If it's your first, if you don't get all of them the first time, try again and see if you could like come up with a reason why you hold it in all the stocks you hold. So. And
catching the falling knife was a great analogy, to be honest. Yeah, that was
people are probably not going to watch that long to find the analogy, though.
But what allows you to actually? I think I'll get back to that one later.
Alrighty.
I want to know, what are dividends?
Dividends. Oh, perfect.
Yeah.
Dividends. So I'll explain it. Dividends is basically if a company grows and actually becomes really profitable, a real company, they're going to release dividends. Basically, what it's telling you, hey, this is my total. This is the total stock you own. You own this stock. You own the stock, and this is the company. Like, hey, thank you for holding our stock. We're going to give you X amount of dollars because you're holding it. That's what it is. And they pay it out either monthly, quarterly, or yearly based on there. It doesn't matter. It's all going to add to percent. It's going to give you 3%. That means every year you get 3% of that. So the company's worth $10 and you're going to get 3% of $10.
Because you invested.
Yeah, sorry. The stock is worth $100.
Yeah.
You own one stock. If it's a 3% dividend yield, you're going to get $3 at the end of the year, regardless what happens. So basically, it's kind of like there's some ideas that's like priced in. It's because if they reinvested in the company itself, it would go up around 3% in its stock price either. But the thing is, it's not. I kind of have a problem with dividends because a lot of older people, it's more like an income-based thing, and a lot of companies that do dividend-based or people look for high dividends. Anything above 1.5 is kind of considered a dividend company, and they're like more blue chips. Usually the more how much dividends the company has, as long usually it's more of a stable company, and they're giving out for people to hold over time. They're not really growing as much. So it's not the idea that even if they did invest in dividends, they wouldn't grow more. It's the idea these companies are they're like safer options in the market. Like they're not going to go down as much in recessions, which is good, but they're also not going to go up as much. So that's what I said, risk for reward. You want to find the idea of the S&P 100 is you want to find the best reward for the least amount of risk. So and if you invest something small, it's going to have a huge amount of risk and a low amount of reward. But the thing is, you could get two exact companies with the same exact size, same exact everything, but one's going to have a better risk for reward inherently. And your job as an investor is to find that or to not find it and let the market as a whole do good for you in total dividends. But there is, I have another bad thing about dividends to investors. There is something called dividend traps, where if new investors want to get into dividend investing, you'll look for ultra high, 8, 16%. That sounds amazing. Like if a company is going to give you 16% dividends, you always think that's good, right? Well, that's going to basically mean the company is going to go down over time because the S&P average is 8%, 10%, right? So it's impossible for them to sustain 16% dividends while going up as much at the same time. It's impossible. So.
Okay.
So that's why. So it's kind of like priced in with that stuff. So the idea is that it's really hard for new investors to get dividends because they get obsessed and they lose out on gains because not enough growth, and they invest in bad companies that get on too high dividends as a dividend trap. So it's good. I don't mind dividends. It's small. I have it a tiny bit, and companies that have dividends perfectly fine. Like Google has dividends, they have dividends, but they're majority growth companies. But when you're older, like if you're gonna enter retirement, I have not a problem with you investing dividends. If you're older, or if you're like under you're 50 years old, that's kind of high. But if you're 50, you're young, so then you probably shouldn't be investing in dividends yet. My opinion. Other people have different opinions, but that's just what I say. So.
Sorry, let me switch this mic. So does that mean? So in terms of risk to reward, actually, I do. So since I'm always using the risk to reward ratios as I'm trading, right? Would you say that risk to reward isn't as in trading? Like obviously you want to have a low risk to reward, but would you say that risk to reward doesn't apply as much? For example, like in the S&P 500,
no,
since it's lower risk.
No. We don't calculations in risk to reward long term trading. It's more of like a relative term I'm throwing around, just like get the idea of if you're investing, I got this weird comment. It was terrible. Let me explain this comment. It was really bad. A lot of people that comment don't really have that much understanding. And so this guy was telling me, one, his numbers were wrong, but he's telling me his opinion was that why are you investing in the S&P when the top 7 stocks literally can get you the same exact return? Well, one, they actually did do better, but if let's say they did, so he's like, why would you want to hold all these stocks? So the idea is risk for reward, right? This whole 100 stocks, diversification leading usually to less risk if you do it in the right way. Why would you want to hold 7 companies that give you the same exact reward as this when you're taking on more risk because you have less diversification and you're all allocated towards technology? You have 7 of these technology and growth companies that are going to fall at the same time, and they might like earnings can happen. That's 7 companies that are on the same sector. You're not diversified at all. You're in these same concentrated companies, and this is going to give you the same exact return. Why would you pick these small over everything else in here? So there's really no reason for that comment. I mean,
yeah, no, that makes sense actually.
Yeah.
Like, and if you were to do individual stocks,
like,
you would actually diversify at least your individual stocks.
And the thing is, like, it's kind of counterintuitive. I'm saying this, like, even as me, sometimes we're not going to outperform every single time. And the idea is most people don't outperform. Literally, the numbers are crazy. 50% of like professional hedge funders, like billion people, they don't outperform. Professional traders, if a professional hedge fund, like professional money managers, if you give them their money, they will not overperform long term. Give it 20 years, guaranteed to underperform because they're doing what we call fluff. They're going to invest in the S&P, but also fluff it out with safer companies, international bonds, which are going to almost guarantee you to underperform less. And on top of that, you're paying fees. So instead, you can just put in the S&P at the same time. And for me, like regular traders that pick their own stocks, you have a 5% chance of outperforming the S&P in 12 years, which it sounds terrible, but a lot of people like to gamble and like don't do any due diligence.
Oh, that's actually crazy. So,
I think I can possibly beat it, but like most of the time, it's going to be barely anything. It's not going to be a lot. Maybe I'll come out with an extra like 10, 20,000 and 100,000, maybe my $2 million portfolio. But for the average person, it's not really worth it to do it. So, but it is fun for me. I like doing it.
So you would say it's actually more difficult to outperform the S&P 500, if you were specifically choosing the stocks that you wanted to invest in.
I'm not saying it's hard to outperform it.
And that's the 8%. So it's hard to outperform that 8 to 10% return that it makes.
Yeah, technically that doesn't really work because if you hold the S&P, you can't outperform it because you're like matching it, but it's really hard to match it in the long term because in a bull market, anybody could pick risky stocks, and in the bull market, they're going to jump up like Palantir and Hims has done. But in like this is a crazy bull run we're experiencing. And like usually when the stock market crashes and stuff like that, and like the long term, if you look at 20 years, they're not going to outperform. Best case scenario, they match it or they beat it by a little bit, which is why it really isn't worth it to invest outside S&P unless you really want to get into this. Like I said, it's 10% of your portfolio. You'll win sometimes, you'll lose sometimes. And at the end of the day, if your overall don't get as much, it's 10%. So don't worry about it. If you really want to start doing that, but just generally S&P, I don't want to give you the conception that the S&P is the best because it's the best for all ages because it's so diversified and like all these safer companies and high growth. But for younger investors, I usually, for me, I'm not telling you to do this, I'm doing this, is 50% S&P and 50% growth. SEHG, which is basically, I explained this to him, the Nasdaq with top 100 technology companies, it's just the top 100, right? We already have the largest S&P 500. We have the largest. So having the largest 100 technology companies is kind of like over-concentrating in my opinion.
Over-concentrating.
Yeah, and when you get these top 100, we're not accounting for growth. We're not accounting for valuation, which is like, but that was an old school way of doing it, just having that. But there's a better thing that's coming out more recent times. Well, not that recent, like 25 years. But SEHG, what it does, it takes these top technology and growth companies. It takes that technology. It doesn't only put technology. If you're going to grow, it's going to put you in there. So even if you're a financial company and you're going to grow just as much, it puts it in. Boom, instant diversification. If you're overvalued if you're not going to grow as much and you're overvalued, they're going to take you out. If you haven't grown in the past 5 years, we want consistent growth. We want something that's predictable, so we take you out. It basically picks and chooses what type of company you want to put in there, and it's cheaper to hold than the Nasdaq. It's cheaper to hold, and of course over the long term, it has done better. But in the recent terms, when the market's a little more volatile, which it's going to continue to do because of new technology, the SEHG is way better because it gives you more diversification and it like tracks it. It's kind of like passively managed for you, besides just holding the largest. So
got you. Yeah.